Before you check your portfolio today, you need to understand something important because what just happened in the financial markets was not normal. On April 7th at exactly 5:32 p.m., Donald Trump posted on Truth Social announcing a ceasefire with Iran. And from that single post, the world learned two things. First, Truth Social somehow became one of the most market-moving apps on earth. Second, markets absolutely hate uncertainty. Because the moment traders saw the word ceasefire, stocks exploded higher. The next morning, the S&P 500 jumped roughly 2.5%, the Nasdaq surged almost 3%, and the Dow climbed more than 1,300 points in one session. It was one of the strongest days markets had seen in nearly a year. And the rally didn't stop there. Over the following weeks, stocks pushed back toward record highs. Financial media instantly called it a relief rally. According to the headlines, investors were celebrating peace in the Middle East. There was only one problem. That explanation made absolutely no sense. Because while markets were flying higher, the ceasefire itself was already falling apart in real time. Tensions were still high, military activity continued, and shipping routes remained disrupted. So if peace wasn't actually back, why were markets acting like everything was suddenly perfect again? To answer that question, we need to rewind and look at what Wall Street looked like before the rally began. And trust me, this story goes much deeper than investors felt optimistic. Back on February 28th, the United States and Israel launched joint airstrikes on Iran. Shortly afterward, Iran responded by shutting down the Strait of Hormuz, one of the most important oil transportation routes on Earth. And markets completely panicked. The S&P 500 entered its worst 5-week losing streak in almost 4 years. By the end of March, the index had fallen nearly 9%. But underneath the surface, something even bigger was happening. Wall Street wasn't nervous. Wall Street was terrified. Hedge funds began dumping positions aggressively. According to Goldman Sachs, hedge funds were selling faster than at any point in the last 13 years. That matters because Goldman has visibility into hedge fund positioning through its prime brokerage desk. They can see what large funds are buying, selling, borrowing, and shorting. And according to Goldman's own numbers, hedge fund selling during Q1 reached levels not seen since the pandemic crash in 2020. At the same time, leverage across the system was near historic highs. Some hedge funds were operating with more than 300% leverage, meaning even small market moves could create enormous losses. Then came the bearish bets. Short exposure against ETFs like SPY and QQQ reached the highest level since COVID. In simple terms, Wall Street was heavily betting that markets would collapse even further. Then, on March 19th, commodity analyst Rory Johnston went on television and basically sounded the alarm. He warned that disruptions in Middle Eastern oil supply could create a shock too large for the global economy to absorb. According to Johnston, if the Strait of Hormuz remained closed, the world could lose roughly 15 million barrels of oil per day. That is an absurd amount of supply. He warned oil prices could potentially surge to $250 or even $300 per barrel. And if that happened, we wouldn't just be talking about inflation anymore. We'd be talking about a global economic depression. Now fast forward 6 weeks later, because what happened next became one of the craziest reversals in recent market history. By early April, sentiment had become extremely bearish. Traders, hedge funds, analysts, and institutions were all leaning heavily toward one side. Everyone expected more downside. Then came Trump's ceasefire announcement. And when markets opened the next morning, it looked like someone plugged Jerome Powell's money printer back into the wall. Stocks exploded. More than 400 companies inside the S&P finished green that day. 13 stocks hit brand new all-time highs. Meanwhile, oil prices collapsed. Brent crude dropped around 13.5%, while WTI crude plunged more than 16%, marking the biggest one-day decline since 2020. At first glance, the story seemed obvious. Markets believed peace was coming, oil prices fell, and investors celebrated. Except there was one major issue. The shipping data didn't support the everything is fixed narrative. According to maritime intelligence company Windward, which tracks global shipping using satellites and AI, only 5 outbound oil carriers were detected moving through the Strait of Hormuz after the ceasefire announcement. Normally, around 130 ships pass through daily. That means traffic was still down roughly 96%. So think about that for a second. If the shipping crisis was still happening, if tensions were still high, if the ceasefire was already breaking apart, then why were markets acting like the world suddenly became stable again? And this is where the real answer appears. The rally was not mainly about peace. It was a giant short squeeze. And once you understand how short squeezes work, everything suddenly makes sense. Here's the simple version. When traders short a stock, they borrow shares and sell them because they expect prices to fall. If prices drop, they buy the shares back cheaper later and keep the difference as profit. But if prices rise instead, they lose money. And because they borrowed those shares, eventually they must buy them back, no matter what. That creates a dangerous chain reaction. As prices rise, short sellers lose more money. At some point, brokers issue margin calls demanding more collateral. And when traders can't provide more capital, they're forced to close positions by buying shares back immediately. That buying pushes prices even higher, which causes more margin calls, which creates even more forced buying. That feedback loop is called a short squeeze. And on April 8th, with short positioning already near extreme levels, the squeeze began. But that was only the first domino. Because once markets started ripping higher, the algorithms entered the story. This is where CTAs, or commodity trading advisors, became important. CTAs are systematic trading firms that use rules-based models. They don't care about headlines. They don't care about politics. They don't care about wars. They simply follow price trends. If momentum points downward, they short. If momentum flips upward, they buy. It's completely mechanical. Goldman Sachs reported that CTAs were sitting on roughly $30 billion worth of net short exposure before the ceasefire announcement. But once the S&P crossed certain trigger levels, those algorithms flipped direction instantly. And they didn't just reduce shorts. They aggressively went long. Goldman originally estimated CTAs would buy around $40 billion in equities during the reversal. Instead, they bought roughly $86 billion within just 5 trading sessions. That made it one of the fastest buying waves ever recorded. Then the third domino collapsed. The options market. This part matters because modern markets are heavily controlled by options flows. When investors buy call options, dealers on the other side often hedge risk by buying the underlying stocks. This process is called delta hedging. And heading into the ceasefire announcement, the market was trapped in a negative gamma environment. That means dealer hedging amplifies market moves instead of calming them. So as prices rose, dealers had to buy more shares. And that buying pushed prices even higher, which forced even more hedging. So now you had 3 powerful forces hitting the market at the exact same time. First, the short squeeze. Second, systematic CTA buying. Third, dealer hedging from options flows. 3 giant dominoes crashing together all at once. That was the rally. Not peace. Not optimism. Not economic strength. Just market structure. And the funny part is this isn't even unusual anymore. We've seen versions of this exact movie repeatedly over the last decade. Back in December 2018, markets were crashing because investors feared aggressive Federal Reserve rate hikes. Then Jerome Powell used one keyword during a speech: patient. That single word triggered one of the largest rallies in Dow history. Or look at August 2024, when the Bank of Japan raised rates for the first time in 17 years. The yen carry trade started unwinding, markets panicked. The Nikkei crashed 12% in one day, then rebounded 10% almost immediately afterward. Different headlines. Same mechanics. Because the structure of modern financial markets has completely changed. 20 years ago, markets were dominated by humans studying companies, reading earnings reports, and analyzing balance sheets. Today, most of that world barely exists anymore. Around 63% of U.S. stock funds are now held by passive index funds. That represents trillions of dollars moving almost automatically without caring about company fundamentals. Passive funds simply buy based on index weightings, which means the bigger companies become, the more passive money automatically flows into them. That's one reason the Magnificent Seven now makes up over 1/3 of the S&P 500. At the same time, active investing has become dominated by giant hedge funds like Citadel and Millennium. These firms operate with massive leverage and strict risk systems. When losses hit certain levels, computers force liquidations immediately. No emotional debate. No waiting. No deep analysis. Just an instant reaction. If you like this video, hit subscribe and like so you can be an expert in finance. This is Wealth Logic Finance.